Hello and welcome back to KD's Business Tips. We're in a series on tax planning for business owners, and in this video we're going to talk about finalizing the year end and how that relates to tax planning. 90% of the tax planning is done up front, in advance. Most tax planning is done in advance. That's the key to tax planning. But there is a small portion of tax adjustments and planning that can be done when you're finalizing your year end, or adjustments to the plan, should I say, when you're finalizing the year end, the corporate year end of the company. And this is really a key time that you should be involved in the process. Now, the accountant is going to do all the work, but you need to be involved in the process, answering questions, providing anything needed, involved in that tax planning, understand what your taxes are, knowing how much you have to pay, and so forth. Okay? And the first thing that you need to do is to make sure no income or expenses are missing. Look at the income and expenses. Look at the profit and loss provided to you and say, okay, is that right? Is there anything missing? Who knows your business better than you? If the expenses are missing, you're the one that's probably going to know, because the accountant only goes off the documents that are there, but what if there's documents missing? What if you paid cash for something, right? You need to be aware of these things. So make sure income and expenses are correct, and income is a key, obviously. You don't want to pay tax on income you didn't get. Now, if your shareholder balance is at negative at the year end, then that means you probably have either had to pay back the company, or you have to take an amount in wages or dividends. So we want to make sure, we want to plan that shareholder loan, what you have and what you're going to be receiving for your personal taxes, because your corporate year end issues you the income to go on your personal taxes through T5, T4, dividends and wages, right? And if your shareholder loan is positive as balance, your shareholder loan balance is positive, that changes things, because now the company owes you money and you get to pick and choose. How much income do I want? Do I want to claim income? Do I want to pay tax? One of the key factors at this point, and even before tax planning, is how much you need for credit. Do you need a certain amount of income for credit? Because if you need higher income for credit, you're going to pay higher tax. Then it's not about just tax planning. It's about, hey, I need higher income so I can get this mortgage next year, or my mortgage broker said I need this income 2 years in a row, whatever it is. Get that information as soon as you can. Know before advance when you're going to borrow. It will help a lot of things. Now, you don't always know that, I understand, but the more you can plan in advance, the better. And then when you do the year end, you can plan how much income you need. And if you're in positive shareholder loan, you get to choose how much income you do or don't want. Always claim something if you can, of course. Now, remember that you can only allocate dividends to the amount that retained earnings are in positive. We've talked about this in numerous other videos. Whatever's on that retained earnings on your balance sheet is what you can take in dividends. And if dividends are cleared, of course, we're filing a T5, and that's due by the end of February. Keep that in mind. By the following February, that February is due. The real keys for tax planning for business owner, though, is overall, we want to pay the lowest amount of tax, other than credit if you need more for credit, but overall, we want to pay the lowest amount of tax between the corporation and you and your family, right? You and your spouse, or you and your family. How do we pay the lowest overall tax? So when you're doing that tax plan, you're looking at the overall tax, but you're also factoring credit, as we talked about. And to do that, we run scenarios. We run scenarios. Okay, if we did it with wages, we did it with combination, if we did this much, if we carry forward some shareholder loan, we run some scenarios and see what the best case scenario is for you to minimize your tax. Now, a lot of this should be done in advance. How much money you're taking out, what you're going to be doing, and how much tax you're going to be paying should be done in advance. But when you get to that year, and you can really tweak it, you can finalize it and tweak it, right? And at the end of the day, the final thing you're going to do is prepare that personal tax return, and it needs to correspond with what you issued from income from the corporate year end. If you have any questions at all, we'd love to hear from you. If you haven't subscribed yet, please subscribe, and we'll look forward to seeing you in the next video.